right? So what is rebalancing? Especially for equal weighted, but for others as well, of course, the balance changes, the weights change, and you need to readjust them. So that's what rebalancing is. It's most frequent in equal weighted, but it's also there in fundamental weighted, price weighted, and as well as market cap, because price and market cap change. The fundamental weighting changes, so that needs to be rebalanced. Reconstitution means you take one security out and put another one in, right? So let's say Exxon going out, Netflix coming in for S&P 500. That is reconstitution. So what will be the frequency? This has to be pre-agreed, right? Because I mean, think about it, right? S&P 500 is an index. It's not a stock. It's not something you can buy. It's just calculated and it tracks. Now, if somebody says, I want to buy this, well, you have to go for a fund or an ETF that tracks it, right? So something like SPY, which is an ETF that tracks S&P 500. So now, if I am the manager of SPY and I'm tracking your S&P 500 and S&P 500 is taking out a stock and adding a stock, well, you need to tell me at what frequency you're going to do it. And this is something I need to prepare for, because then I will also need to sell this stock and I will need to buy this stock. So this is something you will learn more about in CFA level 2 and level 3, that how exactly it's done and what are the different ways of doing it. But as of now, CFA level 1, you just need to understand what it means. Right, so now how do we use all of this? Of course, we need to use it to measure the return of a certain investable universe, right? That could mean one given market, such as the US market, or a part of the market, such as the technology stocks, which you can measure through NASDAQ 100. That's an example. If the market is going up or down, so it helps you gauge the sentiment, right? And overall risk as well. So you look at the volatility, and then that gives you an idea about, okay, is the market going up and how much risk is there in the market going up. So think of 2007 to 2009, think of 2020 COVID scenario, right? So you understand that, okay, this is the average return on this particular segment of the market or this particular market as a whole, and what's the risk in it as well. So then you can use that as a proxy for asset allocation models in different asset classes. Then you can say, oh, look, US stocks, this is the average return based on one index, right? Chinese stocks, Indian stocks, European stocks, right? Real estate, fixed income. So you can actually then compare what's really going on in different asset classes and different parts of different asset classes based on these indexes as a representative of what's really going on inside them. And most importantly, what we have been discussing from the very beginning, that if you are an active investment manager, your client is coming to you and saying, I want to invest in US stocks, right? And you made, let's say, a 20% return for them. Well, is that good or bad, right? Depends. If the S&P 500 has gone up 30% in that time, well, you've not really done a good job, then have you, right? Or if it has only gone up 5% in that time, then you've done a fantastic job. So it's all relative. You need a benchmark to calculate that relative return. And what I've been saying, like ETFs, which are like, for example, SPY, which tracks S&P 500, somebody who just wants to passively invest in S&P 500. They don't want active management. They want just a passive buy and hold approach in the index. Well, then how are they going to do it? They can't go and buy S&P 500. It's an index. It's not an investable thing. There has to be a unit of something which is buyable, which is investable, which tracks this investable universe, right? And an example of that is SPY or index funds. And what is the difference between funds and ETFs? So funds can be open-ended or closed-ended. Closed-ended, new investment is not possible. When the investment manager is making it, they put it together and a new investment is not possible. But trading during the day is possible with closed-ended because the units trade on the stock exchange. Open-ended, new investment is possible, but you have to deal with the investment manager at the end of day every day. ETF, the good thing is that investment can be increased, reduced, so new investment is possible, and this can be done during the day. So that's why ETFs are becoming really, really popular. Right, so what have we talked about so far? There's equity indexes. They can be broad market, Wilshire 5000, or think of Russell 5000, right? 5,000 stocks. S&P 500 is narrower than that. Nasdaq 100 is even narrower than that, right? Because think about it, right? It's one country and one sector, technology within US. You could have a much bigger approach. You could look at multiple different markets, different countries, right? Let's say one that is for all emerging markets. It will have India, it will have China, it will have Brazil. So, I mean, it really depends on what is the market or what are the markets that you're tracking with it. And based on that, the index can be constructed. The constituents can be chosen accordingly, right? So you can have a very big focus as well, like NASDAQ 100 focusing on technology sector. So that's very much possible as well. Yeah, you can have a style index, so focusing on companies which are value oriented, such as Exxon, or which are growth oriented, such as Netflix. And these are also very useful, you know. I mean, sometimes what happens is because of the economic cycle, and if you've done your economics videos, if you've seen the economics videos, you know what I'm talking about with respect to the economic cycle, that sometimes you're at a peak, sometimes you're at a trough. So there's recessions, there's booms. And at peak, usually what happens is growth companies are doing really well. But then when you are moving towards a recession, people tend to move towards value for money, right? Even more than that, maybe they might move into bonds, government bonds. So there's a flight to safety, right? And then so in that type of a situation, these things do better compared to growth. And then when you're growing, then obviously then growth companies tend to do better. So this is the part of this market behavior. Of course, indexes are not only for stocks, they can be for bonds as well, but we will talk a lot more about this when we get to fixed income. But let me just tell you one thing here, that they are a nightmare, right? I mean, compared to stocks, constructing fixed income indexes are really challenging, because see, I mean, majority of the people who buy bonds, they don't buy to trade them, they buy to keep them. So they're not really trading them. And if you're not really trading them, you don't know the market price. And if you don't know the market price, how are you going to know what the value of the index is, right? It's not like stocks which are being traded all the time. And real estate is even tougher, right? So I'll just come to real estate. But I mean, think about it. A bond might be sold still, but a building is sold once in 10 years. So, I mean, the price data for real estate is even far and few in between. Anyways, coming back to the bond discussion. So these can be classified like we were doing the stocks in terms of different geographies, different sectors. You can do the same thing for bonds as well. And this we will talk about more when we get to fixed income. But just to give you an initial, high level sort of a sneak preview into this, that the way we develop fixed income indices is that it could be based on issuer. Is it a government issue or is it a corporate? So we might have a separate index for government, we might have a separate for corporate, right? Which government or which corporation? Is it British, European, American? Is it long-term bonds, short-term bonds? So based on maturity, type of issuer we already talked about, right? Market sector, style, credit quality. Is it high yield, which is junk, or below triple B, or above triple B and above B, which is investment grade? So based on credit rating, etc., etc. Is it dollars? Is it pounds? Is it euros? So it could be based on the currency as well. Again, guys, I mean, we just talked about all of this, right? These, you can have an index market-wise, issuer type-wise, maturity-wise, credit quality-wise, such as investment grade or high yield. But more on this when we get to fixed income. And of course, you can have them for commodities, you can have them for real estates, and of course, real estates is a nightmare as well. And we'll talk a lot more about this when we get to alternative investments. But I mean, the concept is very, very simple, that if you are not really trading, you're not really buying and selling that building as often. So then if you don't know the price data, right, then how are you going to then calculate the value, right? Because if the building is going to be bought and sold once in 10 years, then it's really difficult to do that. And then what we do is we appraise them. We sort of do something called linear interpolation, that if this was traded here, so we try and connect the dots. But then we will talk about this when we get to alternative investments, right? Right, guys. Hedge fund, again, the same issue is there. These guys, they don't have to report if they're doing badly. And also obviously they don't report if they die. So only the ones that are alive and doing well report the performance. So obviously it will be overstated, right? Because you're ignoring the performance which have done poorly or have died. So this is having a survivorship bias. Again, more on that when we get to alternative investments. So what did we talk about here? What is the purpose of an index? To track the performance, right? You use it as a benchmark to know how you've done against a certain benchmark. How do you do it? There is a price return, there is a total return, which also includes the dividend component. Also, when you want to do it for multiple periods, you should do 1 plus the return in percentage and then multiply it with 1 plus the return of the other one, and so on and so forth. Now, how do you go about doing it? Of course, it really depends what is the investable universe you're trying to track. So what's the market? And then within that, what are the securities? What will be the weights for each of those securities? How frequently will it be rebalanced? How frequently will it be reconstituted? So the selection, right? Index can be broad, narrow, can be depending on whatever is the selection of investment universe. And most importantly, the four different weighting schemes, right? This is the core of this learning module and the calculations that we have discussed. So with price, it's like, think about it like you're buying one of each stock. Equal, you're putting same amount of money in each stock. Market capitalization, you're basically buying all the stocks at whatever their respective prices are. And fundamentally weighted, it's a weighted average approach where depending on what metric you are taking, is that book value, cash flow, revenue, earnings, or dividend, then in the ratio of each of those, then you will do the investment and the return is calculated accordingly. This is also very important in terms of the pros and cons. So fundamental has a value tilt, market cap is having a momentum bias, right? It's over influenced by overpricing ones. Your equal requires frequent rebalancing, and the price one obviously is having an arbitrary way of giving weights because it's based on price, and that does not necessarily mean that high price is deserving a higher weight. Then we talked about the ways of all the calculation, right? So for price, it's the sum of stocks divided by number of stocks. So you think about it as an average price. The little bit complicated area here was adjusting for splits. So you lock the index, you lock the new sum of prices, and then you adjust for the divisor, right? Market cap is easy. Original market cap, new market cap, that is what is going to change the base index to the end index. You can calculate your price return just using this also, where you can do the current minus the base divided by the base, or you could first assume the base index, calculate a divisor, then calculate what is the new index. So that's up to you, right? Both will give you the same answer. And then you can calculate the dividend. For dividend here, you'll take the total dividend per share for as if you're buying one of each in the price, and then you'll divide it by the sum, the original sum, to calculate the dividend yield. For market cap, you'll take all the dividends, so dividend multiplied by number of shares, so total dividend and total market cap beginning, and that is how you calculate the dividend yield for market cap. For equal, you calculate the return, both price and dividend, each stock wise, right? So you'll take the dividend, compare it to the price. You'll take the price change, compare it to the price. And each of these you will calculate the return and then take the average of that, right? So you'll add them all up, divide by the number of stocks, and that is your average return. And for fundamental, of course, it is weighted average based on whatever fundamental metric you're taking. That's the real core of this reading. The rest is more theory, rebalancing and reconstitution. Of course, rebalancing means adjusting the weights. Reconstitution is changing the securities. The frequency is really important. That has to be told because people are tracking your index. Obviously, they need to know if something is going out and something is coming in, right? We also talked about the uses of indexes. Obviously, they help you to track the performance, but they are also helping you gauge the market sentiment, to know about the risk, right? They're used as proxies for certain asset classes, benchmark for active performance, and model portfolio for tracking funds and ETFs. And we talked about the types. They could be broad, they could be focused, narrow, right? They could be for multi-market, broader than broad. And of course, you can have any combination of these. You can have for style. Some might be tracking value stocks, others might be tracking growth stocks. You might have different sectors, you might have different sizes. So one for small companies, one for large companies. You can have all variable possibilities of all of this. Different combinations are possible, right? Market cap, the good thing is that you can have it for small, medium, and large. Value can be based on value and growth. right? And various different combinations. You can have large cap value, large cap growth, mid cap value, mid cap growth. So, a lot of permutation and combination can be done over here. And it really helps you to understand what is really going on in the market, right? What's doing well, and then you can position your portfolio accordingly. So these are really interesting tools actually when you practically see their use. Right, of course, you can have indexes for bonds as well. More on this when we get to fixed income, but you can have them divided across, categorized across various different types, that the type of bond or the market of bond or the maturity of the bond or the credit quality of the bond. And similarly, you can have for alternative investments, whether it is for commodities, real estate, or hedge funds. And we will definitely talk a lot more about this when we get to alternative investments. And finally, your security market indices. They represent different asset classes, different geographies, right? So, for example, you can have Dow Jones Industrial Average. Obviously, that's for industrial companies. Barclays Global Aggregate for the bond. So, this is a fixed income one. More on that when we get to fixed income. S&P, of course, the main one is S&P 500, very popular for your US stock market. And then you have different variants for different types of use cases as well from S&P. So multiple indexes by S&P. Another very popular company is FTSE. Another very popular company that does indexing is Russell. So yeah, a lot of interesting work in this space.